I guess we brought you here under false pretenses. Graham is right. You can't actually take all of the pain out of financial statement audits. However, we can always try, we can always be ever optimistic. We can hope that we're not working till 12 o'clock on a cold July evening. We can always make it better, right? Okay, so why are we here? Why are we talking about it? Why are you all here? Obviously there is pain. We were thinking a little bit about why it's actually important to do the financial statements. Really, they only happen once a year. And it sounds like that's just one little part of the year, but it really does go for about 9 months or 12 months. So you prepare one set of financial statements, but it's over a period of time. And of course you were audited over that period of time. The financial statements are a public document in the end, and the findings are reported to Parliament, particularly if you're lucky enough to get an A and a B finding. The financial statements do belong to the CFO, so they represent the CFO, and of course your accountable authority, secretary, CEO, whatever you call that person, signs off on them as well. So it's a very public document, and it's an important document. And while you're having all that fun, your monthly BAU must continue. So we're going to talk a little bit about how to best manage the process, probably more so than the challenges, because the challenges are wide and varied. So we'll talk about that today. It's going to seem like common sense to a certain degree, but every now and then it's good to be reminded how to do it, what the process should look like, and just to have a little bit of a reminder about how to partner with the auditors, with your audit committee, other people that you need to get involved.
So these are the topics we're going to talk about today. First of all, the timeline, project management, your audit finding, remediation, financial statement preparation, specific balances that you need to concentrate on, any technical papers or issues that you know about, quality assurance, and the audit committee support. So we thought we'd put this overview document up just to really show you as an overview what we're going to talk about today. So up the top is the audit timeline. For most of you, that is most of the year, as Paulette said. The audit, I can't say this to our auditors, it's a horrible thing to say that the audit almost starts now for next year. In the next couple of months, we're really doing our planning stages of the audit. We're talking to the business areas about what their issues are for the year, etc. Then interim happens in a few months' time. This is also for 30 June clients, of course. Interim happens where we come in and look at your controls and test transactions, look at the transaction cycles that have been operating during the year. Then after year end, we come into our final testing. Final testing is really looking at all your balance sheet items. So looking at all the supporting documentation that you've got on your balance sheet, and then of course your financial statements and all of your fund disclosures, and then reporting after that. And so what we're also going to talk about is how you manage that process with your auditors. So overall, project management, which also starts very soon. And under that comes your remediation plans, your preparation for soft and hard close, your year-end preparation, your audit support, and of course talking to your audit committee and your financial statement steering committee if you have one.
So we're going to tag team a little bit today. As Graham mentioned, I'm going to do the CFO role, hence the white hat, and Selina's going to be the auditor and representing what they think about what we do. Do we have many auditors in the audience? Okay, that's not so bad. So,
hello, friends.
Yes. I was just going to say, you're fair game. So project management, this is the number one. This is the key. This is what you need to do. So while you'll be veering away, putting together your numbers, making sure your numbers are right, someone's got to be watching the big picture, making sure that we get to where we need to get to and the time we need to get there. So really the first thing you need to do is appoint a project manager. Now this is scalable. If you're a smaller agency or entity, have someone within your team who's not necessarily involved in the preparation be your guide and your conscience. They will ask you where you're at, have you done this, have you done that, and just keep you on track. In a bigger agency, of course, it becomes much more complex and it's much more important, but it's important across the board. So appoint a project manager. Start planning as soon as possible. So last year's audit's finished right now, right? So next year starts now. And that talks about your planning. If you have audit issues to remediate, start thinking about it now. Talk about your lessons learned from last year. What did you do well? What didn't go quite so well? What do we need to change? One of the key things that my experience tells me we don't do very well as a CFO team is make friends with the auditors. So the auditors are friends, not foes. So if you remember that Nemo line, it's fish are friends, not food. Auditors are friends, not foes. The relationship is really important because you can work anything out in a good relationship. So make sure your project manager establishes that relationship and has it as an ongoing element of the engagement. Include external stakeholders in planning. When I say external, I mean external to the CFO team. So that might be business areas that might have something to remediate. It might be business areas that provide you with vital supporting documentation. It might be business areas that support the auditor in their assessment of controls. And of course, assess your risks and issues as you go.
So I think from an audit perspective, if you get us involved in your planning early, so when you start setting up your project plan for the year, maybe invite us along, talk to us. We'd like to give you, I guess, feedback on what we think the focus areas are for the year, what we think the issues were last year, what we see as issues coming up. I guess you could have changed business systems. You might need to do special work around that you're not aware of that we're going to ask you questions on. So yeah, if you can involve us early, then that's no surprises for everyone. And your project plan should include your entire audit life cycle. So starting from the beginning of your planning now with all your audit issues from last year and everything else you really need to consider that ends up in the financial statements at the end. It's not just the financial statement preparation process. Start early. That's the biggest tip we have.
So you've done your planning. As the project manager, make sure you monitor your project against that plan. Sounds like common sense, right? But do it. Keep track of audit issues as you go. Business issues, other issues. Keep track of all those issues and any adjustments, potential management letter findings, those sort of things as you go. You have to be on top of that. And again, that comes back to a good relationship with the auditor. Know what they're thinking. Are they thinking they may be considering a management letter finding? What does that look like? How are you going to respond? Again, communicate regularly. Keep those lines of communication open.
Yeah, make sure your project plan includes your quality assurance processes. What we tend to see is that quality assurance happens at the same time as the audit, which is not ideal, because ideally we're auditing information that's already been reviewed and looked at. So if you put those processes in the plan, then you can make sure you have the timeframes planned so that you can actually complete them before the audit starts. This sounds obvious. Read the audit strategy document that the ANAO give you. That's assuming you're government clients. If you're not government clients, any strategy document and information that the auditor gives you.
Do you know what the audit strategy document is? Okay.
It's really the plan, yes. Okay. It's the plan for the audit that the auditors have. So the auditors come up with their key focus areas for the year and the significant areas that they're going to audit or they think that there are risks in the audit for the year. If you don't get given an audit strategy document or you don't get to see it, you can ask the question. So the auditors always know what they're going to focus on. So you can ask anyone in the audit team, they should know. But if you read that, then you know what we're going to focus on and then you can know how to prepare, especially well in those areas. This last one is time slippage needs to be managed because deadlines are tight. Now, deadlines are tight for every single person in the process. Even if you're starting now and you're starting the plan in December, January, February, you think that if you slip by a couple of days, it's not that important because you've got a few months to catch up. But every single thing escalates as you get closer to year end. So slippage at every single point during the process is important to manage. And I say that, I guess, because I'm a little bit passionate, because auditors come last in the process. So however it slips throughout the year gets compressed for the poor auditors whose deadline never seems to change. So it's a little...
Cover your ears for a minute. I've heard those teams that say it's a strategy to do that because the auditors have to get it through it faster. Yeah, I'll be really careful with that. You just upset them, make them angry, you'll get a finding because you didn't get your preparation organised. So you could try that. It's not going to work.
Yeah, disciplined approach. That's the main point here. Yeah, if you're disciplined about every single part of the process, you'll get there on time and it'll all be smooth sailing.
Yes.
Maybe still painful, but still smooth.
Yeah, fingers crossed. So we'll talk a little bit about the project management plan. So the project management plan we've just been talking about is quite high level, getting everyone organised, understanding the timeline and the milestones. There are two other plans that are very important and are included in the greater project management plan. It's the remediation plan. If you have a number of audit findings, both external, internal, and other issues, you might want to include them in the remediation plan. Remediation plan is a really good way to communicate what you're trying to do, particularly if you're including outside stakeholders. And detailed financial statement preparation timeline. We'll talk a little bit about that in a minute as well. To give you an idea of what a project management plan might include, and again, this is scalable, you need to have your project governance. Who's involved, what are they doing, and what are they responsible for? So things like your project sponsor, your owner, your managers, and your team members, and any outside stakeholders like the Audit Committee. From a financial statements preparation perspective, you really do want to detail or understand in there your lessons learnt, communication, what the management sign-off is going to look like throughout the organisation, management assurance, version control. We'll talk about that a bit more in a minute as well. That's really key. When I talk about version control of your financial statements. And escalation of issues. How does that happen? So within the project plan is often a milestone and key deliverables schedule. And if we go to that, this is, I don't know if you can read that. Can you read that? A little bit? Okay. Really what I want to show you here is the concept of having a timetable with major milestones where you're engaging with key stakeholders. So, the Audit Committee's in blue. You want to know when that is so you can get prepared for that. If you have an FSSC, how does that work? Look at whether ANAO gets engaged and what their responsibilities are. This is a really nice tool to get all those stakeholders involved and agreed on a plan. You can really nail your auditors down to a time and a deliverable so that you can make sure that your financial statements get to the Audit Committee at the right time. Isn't that right?
Yeah, that's right. And also, I guess from an auditor perspective, you're telling the auditors what the dates are that are important to you. And you'd be surprised how many times that's a surprise at year end for a lot of us.
Yeah, sometimes you don't get told about the Audit Committee dates, right?
No, that's right.
So, yeah, interesting. Next. Audit finding remediation. This is something that you really do need to focus on, particularly if you've got significant findings. That's going to create some angst in the organisation from the secretary to the Audit Committee and down. So, even if you've got C findings or management issues, you do want to have them cleared up in the following year. In certain cases, I know the ANAO likes to escalate issues if they're not resolved year on year. So create the plan as soon as possible. Involve stakeholders, particularly business areas if they're involved. You need to get them to understand why it's important. Sometimes you have to put them in front of the Audit Committee to tell the Audit Committee what they're going to be doing to take it seriously. I don't know if you guys have had that experience, but I certainly have. And communicate. Again, that relationship with the ANL and the Audit Committee is really important. Something to also consider that we can forget is current year interim findings. We need to add them to the remediation plan and consider them as seriously as we do with last year's issues.
From an auditor perspective, the most important things with audit finding remediation is actually just to keep us informed throughout the year as to how you're going. So really what your plan is and then how you're going against plan. And I know Paulette said before, the auditors are your friends, but you really have to realise that it's a teamwork to get the financial statements signed off in the end. You actually have to work with your auditors, not against them. And I mean, everyone, there's personality issues with everyone in life, but really, once you get the auditors on board and working with you, you can communicate this freely. So if you're actually not on plan, then you can have a chat with your auditors and say, look, what are the implications of this? We're not going to make it. How are we actually going to come out of this okay in the end, and you still sign off and we still keep going? And I guess with the interim findings, anything that's going to have a material impact on your financial statements that's been identified at interim somehow needs to be resolved before the financial statements are signed. So it might be a big issue that can't be resolved before the financial statements are signed, but you've got to come up with some way of mitigating the risk so that you can get under the materiality threshold and get those financial statements signed in the end. And your auditors are really helpful, well, they should be really helpful with this process to tell you specifically what they're after and how you can achieve that.
I think it's important to realise that having an issue in the financial statements is an absolute pain in the arse for the auditors as well. The fact that they have to consider what kind of audit report they give you, the qualifications committee they have to go through, you know, they're going to try their best to help you out because it helps them out as well.
Yeah, very true. So, well communicated plan. That's the aim of the game.
So a remediation plan might look like this. On the left is a table of contents, and as you can see there is a list of potential issues or actually findings from prior years. There's 5 of them I've listed there. On the right, I've blown out number 2, commitments, just to give you an idea of the kind of things you might put in this sort of a plan. So you want to look at the risk of the balance that you're assessing or the issue that you've got. How hard is it to resolve? How many people do you have to involve in that resolution? What's your current status? What was your previous status? Are you on time? Are you making progress? On the right, we talk about, you know, the background and the issues, and you can see there in the blue box, we've actually posted in the ANAO finding. That's exactly the words for that particular finding at that particular time. Then you talk about your solution. You look at your activities to resolve that issue, and you have a progress update. So this can become a plan and a means of communication to your audit committee and to your stakeholders as well.
It's our favourite bit, this one.
Now we're getting down to the nitty-gritty. Preparation of financial statements. And the mantra needs to be good quality work papers is essential. And when we talk about work papers, we're talking about lead schedules, reconciliations, calculations, supporting documentation, all of that good stuff. The time that you put into them at the beginning means that you will have less pain at the end. There's less confusion, the auditors know what they're doing, but it also means that you understand what's in that balance and you can demonstrate it. So, you know, good quality work papers are key. Hard close or soft close? Generally, people do soft close. What do I mean by soft close? That's when you roll your financial statements over from last year to this year, update the template, get your numbers, move your numbers to the left, and get all your dates right throughout the document. Update the document as required in words and numbers, but also then load up this year's numbers. So you've got your balance sheet and your balance sheet notes, so it's pretty easy. But really it's getting that template right for this year. So you can give it to the auditors at interim and they can do a premier comparison, making sure the disclosures are right. What's a hard close? A hard close takes a lot of time. It's almost like doing a set of financial statements twice in 1 year. So you might do that in March, you might do it and then do it in June again. Not something I'd recommend unless there's a really good reason. You've got a brand new team, there's complexities in the financial statements, there's major changes in processes, systems, or people elsewhere, particularly in something like employee entitlements or commitments or any of those disclosures that stand on their own and you really don't get to test it until year end. I think our experience is that when you do it for the first time at year end and then something goes wrong, it goes really wrong. So just think about that. And hard close, and Selina will talk about it in a minute, can help the auditor as well. If you've got a big set of financial statements that are quite complex and a compressed timeline at year end, you can do a major balance audit at that time and roll it forward. Detailed team planning is essential. What are the roles and responsibilities? Who's preparing? Who's reviewing? When does it go to the CFO? How does that work? Must make that happen. That was part of our 3 bits of planning that I showed you before. And version control of financial statements. I've seen teams who tie themselves up in knots preparing multiple sets of financial statements. And at some point, you're going to get lost in what change you've made where, and that becomes a problem. I'd absolutely recommend you to limit your versions. I have had experience where the auditors have asked for multiple changes at multiple times. Oh no, Selina doesn't do that. Don't do it. Unless there's extenuating circumstances, stick to your timeline. Because what you do is you give them you give the auditors a set of financial statements when they come in. They audit, they look at the financial statements, they give you whatever changes that you need to consider in one go. You create the next version, everyone's on the same page. You don't do bits and pieces. Because as you all know, whoever's the poor bunny that has to stay there till 12 o'clock at night, flowing those changes through, it is not fun. You want to do it. You want to minimise that time, because it's really not time well spent unless you're keeping those versions under control. And financial statements belong to the CFO.
So I'd agree with what Paulette says about version control of the financials. I think you can tell your auditors, no, you're not planning to make those changes until 5 days' time or whatever your plan is. You're well within your rights to do that, and it actually saves everybody time, so it's good. So when we come in to do our final audit, we're going to be asking for supporting documentation, calculations, listings on all of your balance sheet items, so every single number in your balance sheet, even the small ones, and all of your disclosures in the financial statements. Every single disclosure will be supported by some sort of calculation, assumption, and we'll be asking about it. So I guess my advice is you're doing the calculations once to get the numbers in the financial statements. At that point, just document it clearly so that someone else could understand it if they were reading it, and then file it appropriately so that you can give it to the auditors at year end. Your preparation of this documentation for audit should not be a secondary process. It should not be a time-consuming process in addition to your preparation of financials. It should be part of your process because you're doing it anyway. When I say supporting documentation calculations, a general ledger listing, so a listing of transactions for the year from your general ledger, is not supporting documentation under any circumstances.
Look at you all grinning. How many of you have done that?
I know. You try and fob us off with these things. We know. But really, what we're after is some knowledge that you know what is in the final balance. And that is really determining what makes up the final balance. It's not saying, oh, but this number was there at the beginning of the year, we've done all this throughout the year, and therefore that's the result. That doesn't show me you know what's in your balance, okay? So you've got to provide us information so that we actually know.
So all of you with those sneaky clearing accounts, you need to do something with them.
Yeah. Everything needs a reason. Obviously, if they're really small balances, we're not going to spend much time on them, but everything has a reason. We're also going to ask you for your analytics on all numbers and disclosures in the financial statements. So we're going to see whether you know why things have moved a lot. So we're after the story behind what's happened in your organisation. And it doesn't have to be a very detailed story, but the numbers and disclosures need to back up what you think's happened in the organisation throughout the year and what we think's happened. So really, we'll ask you questions on all number movements, against budget, against last year, whatever we choose. We like to keep it you all guessing and choose different bases every year. But really, there should be reasons for all of it. And same with your disclosures, and even valuations. So when you're looking at valuations, we all tend to rely on experts, our valuers, to do valuations for us. It doesn't mean we shouldn't know why values have changed. You need to ask them. And I guess for our perspective, when we walk in and you give us the information, so when we start the audit, ideally we'd get all the information that supports everything in the balance sheet. In days gone by, we used to get manual audit files. I'm not sure how many people do those now, but everyone's tended to go electronic, which is awesome because we have two. But filing electronically is actually harder than filing physically. People tend to forget what's in an electronic file. And I guess my only suggestion would be to file it as logically as you would in a folder with dividers. And watch what you're calling things too, because often you have your favourite name for a document every month when you produce it, but it might be a name that means something to the financial statements team, but it won't mean anything to the auditors. So just watch it. It's really simple stuff that will keep the auditors busy and out of your hair for as long as possible. An easy process. Good work papers saves everybody time.
So I'm going to say something now that seems like common sense. You all know what I'm talking about here. You know, balance sheet needs to balance, needs to add, needs to cross-check, no rounding errors, you know, those pesky ones. None of them. Spelling and grammar must be correct. How many of you have read Note 1 recently? Look at you all. Shame on you.
Look at the auditors too.
Look, in my experience, it sounds like it's a funny thing, but if it gets to the audit committee and there are spelling mistakes, grammar mistakes, there's formatting problems, it looks odd, they're going to start doubting your numbers. And I know every financial team prides themselves on the fact that the numbers are correct. You know they're correct. The audit committee has not a hope in hell of knowing that those numbers are correct. They're relying on you, the auditor, and the auditors. But when they start seeing a sloppy set of financials, they're going to start thinking about, are those numbers sloppy as well? So again, it seems like common sense, but really, seriously, and to make my heart warm, please do this. It's an easy thing to do. Read the financial statements. They're yours. Own them. Know what they say. There's always that sneaky little sentence at the end that's talking about a special circumstance from last year that you miss every time. Requirements of specific balances. These are all the balances I know you love to hate. But seriously, you need to get them under control. Selina's going to tell you how.
I guess these are the numbers, these are the balances that cause everyone grief every year. And I think it's because the support for them is not as straightforward as for every other balance. Ideally, you'll look at these early on in the year, so you won't just wait till year end before looking at these balances, and get some advice from your auditors, have discussions with your auditors if you're not sure about what you need to do. I guess for assets in particular, most people need formal valuation. I guess if you're a government department, you're valuing at fair value. You need to go out and do formal valuations at least every 3 years generally. So that needs to be early on in the process. You can't leave it to the last few months of the year because you can't get everyone organised and results happening in time. And it also puts undue stress on you when you've got lots of other things happening at year end. Do it really early. Make sure you reconcile that valuation then to your year-end numbers, because lots happened. Often lots has happened since your valuation was done and the year-end. So just a simple reconciliation, nothing too complex. Looking at, I said before, looking at large valuation movements. So there's a couple of reasons generally why valuations move a lot, and it could be because you've got a new valuer and they use a different methodology. That does happen and it is valid to a certain extent. But often it's actually to do with the information that the valuer is given. So you could have a different financial statements team and the person who's dealing with the valuer is a different person and they actually have missed some information or they've given some additional information that has actually caused the values to change. Again, a lot of the time it's all valid, it's just knowing what they mean. And sometimes it's not valid. I had a client that had a valuation a number of years ago and the valuer was missing a key piece of information about the future use of some buildings. And the valuation in the end couldn't be relied on, and it was actually ditched at the audit committee stage, just wasn't accepted and had to go on to the next year. So try to avoid those surprises. Fair value assessments, so when you're not getting a formal valuation, you still need to assess fair value. People avoid that too because it's not as easy as it seems. Try and assess it early, discuss with your auditor. I guess it needs to be a little bit robust. So it can't just be a few words, yes, we think it's about the same as last year, and things seem reasonable, the market hasn't really moved. I mean,
cut and paste last year, this year.
It doesn't have to be too significant, but something with a little bit of robustness. Then your stock take results, most of you stock take your fixed assets. So just looking at your stock take results, what you've done from your stock take, what was missing in your stock take, the decisions you've made that's come from that. It's just make sure it's documented and provided to your auditor. And then your impairment assessment support. So all of you would look at impairment, often when you're stock taking or through other processes, and then it's just making sure that that's documented. Provisions, appropriations, other significant balances, really where you've made estimates and where you've got calculations of percentages that go into another calculation, just documentation of what your thought process was when you were doing those. It's going to help you next year anyway, or the poor person that's taking over from you. So if you can just document it properly the first time and then file it away and just provide it to your auditors, it makes things much smoother. And actuarial reports, if you're using those, know how to read them, know what numbers you've used and why you've used them. It's not as simple as it seems for any of us. Again, start early thinking about these balances. They're not normal, they're not easy.
Similarly, technical papers. If you've got changes to legislation or policy, or there's new systems or a new process, you need to think about how your accounting treatment is working. Is it working? Is it the same? Should it be the same? Do you need to change it? So if you have to write a technical paper, you have to link it to legislation and AASBs. You have to make it compelling, and you often might have to make a compelling argument. Hot topics recently are around revenue recognition of liabilities or provisions. They get a bit tricky. There's a bit of grey area in the standards. Play with it. Work out how to best use it, but make sure it's supported. Include DOF in preparation of the position, particularly if you're a material agency, they will be interested. And then just stand out of the way when finance and ANAO have an argument about it.
Discussion.
Include your internal review timeframes. So again, start early. You need to get this technical paper done and approved before 30 June.
Yes, so start preparing it early and then get it to the auditors early. And this is really just so things can get signed off and out of the way and not a problem at year end, for everyone's benefit. I think if you're putting your technical papers through ANAO, sometimes they'll actually have to put it through their technical division as well. And all of these things take weeks at a time. So it's really just building all of that into the timeframes as well. You have your review at your end, comes to the auditors, they review it, and then the technical advice that they need. And then the healthy discussion that might come after that before the resolution.
Look, I'll also say too, engage with your audit committee. There are audit committee members who are really involved in what you're doing. They love financial statements, they like the technical aspects of it. They are your friends and can be your biggest supporters. There's a few independent audit committee members around town who love this stuff and love to be involved and consulted. So bring them into the tent and they can be your biggest supporter as well.
For everyone's benefit, no surprises at year end.
Quality assurance. So this is something that's different to preparation and review. This is talking about getting someone who's independent of the preparation process to have a little look at what you've been doing with a fresh set of eyes. So it can be risk-based. Just have them look at your work papers, some of the work papers associated with more complex balances to make sure it makes sense to them. Of course, they have to be an accountant and be financially literate. Make sure that's the case. If you don't want to read your financial statements and note one, get someone else to read them. Make sure it makes sense. And it should be done before it leaves the CFO area for any purpose. So that means prior to audit, not at the same time as. Okay, so you still leave yourself open to issues if it's not cleared. Audit committee support. So here's where you keep your audit committee on side. Have a good relationship with them. Often teams forget about the audit committee papers that have to go, and there's a mad rush. Again, someone's working on it at 12 o'clock at night, putting the holes in the pages and putting them in the files. I don't know if you've been there, but I've been scarred for life by one particular experience. So, get it organised. Make sure the communication's there. Get your management representations in place. Again, no surprises. So in conclusion, what are the main takeaways? Start planning early, get your plans in place, create discipline. Don't put the plan in place and then stick it in the top drawer. That's not going to help you. Get technical accounting, remediation, specific balance issues out of the way early. Support and manage the auditors. Remember, they're friends, not foes. The better relationship you have, the easier the progress for everybody. Constant communication to all your stakeholders, your business areas, your audit committee, your FSSC, any other agencies you have to deal with, everybody, have them all on the list. And of course, no surprises for anyone. Of course, every year there will be a challenge. But if you've got all the standard stuff under control, you've got more headroom to deal with it, whatever challenge, issue, problem may come up at your end. And if you've got the relationships in place and you can work in partnership with your stakeholders, that should make it a lot easier.
So it might not take the pain out of the financial statements preparation and the audit, but it'll certainly make it well planned and you'll know what to expect. And those surprises can be dealt with easily.
Have fun!
Your auditors are human too. You can actually create relationships and have fun. I mean, we love this stuff, so.
And auditors are human too.
Did we say that twice?